markets in October of 2024. And JC is going to join me for this. I'm going to start the presentation that she's going to talk about our models, our portfolio models, and give you updates on that. Okay, do I need the clicker? Yeah. First, a little housekeeping. We have some samples on the tables near you of investment policy statements. We have been, and JC and I worked for 2 years to develop this extensive document that is a description of your portfolio. We now need to get it into your hands. Each client may have a different IPS, a different investment model. Some of you may be aggressive, some of you may be moderate, some of you may be conservative. We have 10 different risk profiles. And so it's a detailed model of your portfolio. One per client household is where we're going. Yes, David?
Are you distributing them?
No. These are just samples. I'm going to talk about that. And we think the way we're going to get everybody their copy signed and executed is to do a focused webinar in 2025, and we'll send you your IPS before the webinar and then take you through it during the webinar, and then we can button them up. Does that make sense? So just wanted to let everybody know, but you can see what's coming down the pike. This is I think it's the most extensive IPS document that I know in our industry. IPS, Investment Policy Statement. There it is. And so it just gives you interesting information about your portfolio that we want you to have and to understand. So that's some housekeeping. Okay, another piece. As many of you know, we work with Vanguard. We also work with Dimensional Fund Advisors, especially on the equity side of things. And on the equity side of things, you tend to see capital gains distributions at the end of a year where the fund has sold securities at a gain. And you see this a lot in actively managed funds, right? So let's say the fund holds Apple or NVIDIA or something that's really gone up strongly. They may sell some of it, and you as the fund holder will get a piece of the gain. Several years ago, well, it's not several, it's been probably 3 years, we made a switch from mutual funds that we were using to ETF exchange-traded funds. And we did that because we expected that for several reasons, but one especially is that the tax benefits we thought from the ETFs would be even more. Already what we were doing was very tax efficient, but we thought the ETFs would be even more tax efficient. We're using ETFs from Vanguard, we're using ETFs from BlackRock, we're using ETFs from Dimensional. We're especially using Dimensional's ETFs for stock funds. Less so on the bond fund side, but on the stock fund. And what we wanted to show you is what is estimated. And I caution, this is only what the estimates are because we won't know till the year ends. We're still in calendar year 2024, but the estimates that are coming from Dimensional are that the majority of the third bullet point, no Dimensional equity ETFs are projected to distribute capital gains. So in a year when the market's up, 30%, you would expect, well, we're going to see profit taking, but there will be no projected capital gains distributed to you, which means we do not expect that you're going to face any capital gains tax whatsoever in accounts, not IRAs, right, but in non-qualified taxable accounts. This is not by happenstance. This is by design. It's by design of the way that Dimensional is going about their tax management within these funds, which is extraordinarily complex and adroit. For example, when they make exchanges of shares in their funds, if they are acquiring something, or rather they're selling something at a loss, they may pay cash or receive cash. And in the case of a gain, they may make a exchange in kind for stock. And so the treatment is different, but the net effect of it is that you're not going to have any capital gains tax arising from those funds in your taxable accounts. Just some housekeeping, and I'm gratified to tell you that the decision we made a few years ago to move to these sort of more tax efficient funds certainly pays off this year. Okay, let me start with some economic bits. This is markets as of September 30th of 2024, 1 year, 5 years, and 10 years. And what do you see? A whole lot of up green arrows in any way, in any place you look, whether it's 1, 5, or 10 years, whether it's the US stock market, international stock markets, emerging stock markets, global real estate, US bond markets, global bond markets. This is what 1 year looks like. 35% in the US stock market, 25% in international, 26% in emerging, 30% in global real estate. I want to talk about this for a second and how this fits in with Chris's talk. We had a couple of clients about a year ago who said they didn't want to hold real estate. They were worried. You may have heard about concerns about the office building market, right? Or the retail market, right? Everybody remember concerns about the real estate market? Well, the fund we hold for you isn't just focused on offices. We first deal with the risk of the office building market by diversifying you so that you're not only holding the office building market, you hold the warehouse market. You hold now cell towers. I don't know if you know that's considered to be real estate these days. You hold retail shopping in shopping centers and apartments and so on. So that's the first way we dealt with the real estate market is you are diversified. You're not only diversified by the type of real estate, but you're globally diversified in real estate. You're not only susceptible to risk in the US real estate market, but you're diversified across the world. And so we were well aware, JC and I were well aware that people were down on real estate, but why were we willing to continue to hold our position in real estate? Why? We didn't know where it was going. We just knew it had gotten cheap, right? That's what markets do. We knew that the office market had sold off and maybe other retail markets had sold off. We didn't know when the market itself was going to say, okay, you know, things are cheap enough. I started to see articles that there were buyers coming in. Greenway Plaza itself, where we are, well, we're not technically in Greenway, but it's right there. The Greenway Plaza complex was acquired, right? And so there were a buyer who appeared and paid, I don't know, $500 million or something for all of Greenway Plaza. And I think they probably got it at a good price, right? And look what real estate has done over the last 1 year period, up 30%, right? So that's just an example of how just because you're hearing something's not good and there's going to be office vacancies and so on, doesn't mean it's a bad investment. It turned out to be a good investment. Now look, there's a lot of other good investments, right? But if you sold real estate a year ago and put it in cash, it cost you 30%. That's a big number. Okay? And even the bond markets. Look at the bond markets. 11.5% on the US bond market. Now that's for intermediate term bonds, a mix of them, and even global bonds, 9.78%, right? And you can see on and on. So it's a positive picture in investments that's gone on, right? And here is inflation. Here is the picture in inflation. Everybody can see the mountain that we climbed starting in, January of 21. This is around the last inauguration, right? January 6th would have been about here. And we started to climb a mountain of inflation that peaked at 9.1% on the consumer price index. But look where we've come since then. A real problem is that our government never communicated that a reduction in the rate of inflation doesn't mean a reduction in prices. It's a big mistake that our government did not talk about that. It's the government's fault. We needed an educator-in-chief who said, we're going to bring down inflation, but bringing down inflation is not the same as bringing down prices. What do you have to bring down prices? Negative inflation, right? An overall rate. And this, you can see we don't have it. And the economy isn't structurally programmed to have negative inflation. The goal of the Federal Reserve is to have a little bit of inflation every year. The last time we had negative inflation on any large scale was when? Yeah, it crept in a little bit, Carol, and that's good. Yeah, I think we may have had a quarter or so, but I would say on an extended basis, when is the last time we had any extended deflation? Carter Bush? Nope. When? Keep going, everybody. Anybody born before 1932 in here? Nobody was born the last time this country had an extended period of deflation. It would have been the Great Depression. And since that time, the goal of the Federal Reserve has been to allow some inflation, but not too much. Well, got away from us here. And we can debate why that happened. I think it was a combination both of government spending, but maybe primarily the decision by the Federal Reserve to hold short-term interest rates very low, close to zero, and also to inject money into the money supply by purchasing. When the Federal Reserve makes purchases on what's called the open market, makes open market purchases, that is increasing the money supply. And in March of 2020, the Fed opened the floodgates. It wasn't just the federal government making payments through the PPP, it was the Federal Reserve. And Milton Friedman himself, the great conservative I emphasize, economist, I believe the quote that he says is, inflation is always and everywhere a monetary phenomenon. It has to do with the money supply, all right? So we can blame the government, we can blame this president, we can blame that president, we can blame the Congress, but very often it's in the hands of the central bank. Now look, we've come down a long way, but there are a lot of people who are still hurt. And any price increase to them, even 3%, is too much. Is this helping give everyone a picture of inflation? Now, we see some components here. Shelter inflation. We're still seeing, when you're seeing Vice President Harris talk about bringing some units, 3 million units or so, into the supply. You can see why this is being discussed. Shelter inflation, the cost of housing right here, this blue subcomponent here, remains running itself at over 1%. Auto insurance. Look at how auto insurance was nowhere back here as a source of inflation. Didn't even show up here and here and here and here. Now look at it now. Anybody has anyone not had an increase in their auto insurance rates or a meaningless increase in their auto insurance? Anybody? Nobody. Or home insurance rates, right? Dining and recreation. Look at this. We all know about that and going out to eat. But we also are seeing some areas where, at least recently, we're seeing some disinflation, some deflation, some actual price decreases. Notably, energy, gas prices, right, are down. It's clear. There it is. Gas and electricity prices, and also core goods stuff. Okay? Overall, though, it's a positive outlook on inflation since this 9.1% peak in Mountain in the summer of 2022. But that doesn't help somebody if they are lower income and what they need to see is price decreases, not just slower increases, because these are net increases in prices, 3%. This is the employment picture right now. And we're here. And we can see that the unemployment rate is around 4%, just as you all picked in the poll, is exactly where the unemployment rate is. And also you can see the wage growth rate. This is the 50-year average, 6.2%. So we are under on the unemployment rate. And we are about average on wage growth. JC and I were looking at this slide yesterday, and she very helpfully pointed out, look at this pattern here. Look how weird this is. Look how we have these periods where the two rates, the unemployment rate and the wage growth rate, touch. You would think that would be good. We'd have an unemployment rate of 4%, and we'd have wage growth of 4%. If inflation runs at 3%, people have a 1% real growth in their wages, right? 4% approximately wage growth and 3% inflation, right? But look at these periods where they've touched and then suddenly, whammo, it takes off again. Unemployment takes off. Wage growth drops. It's happened 1 time, 2 times, 3 times, and then 4 times here, that we were in this sort of happy place and it came apart. And this has put a lot of stress on people. Things are looking good and then whammo, right? Their wages stall out in growth and they lose jobs. And this has created political instability in our country. It would really be good if we could get this to stick, right? Everybody see that? But where we are right now, not bad. So things look good in securities. Things look decent in inflation coming back down. Things look good in employment, right? Here's the labor supply. We see we had a big drop in the labor force participation, right? Everybody went home during COVID, and then people have been making their way back. Interestingly, the total labor force has lagged the participation in the labor force by those aged 60 to 64. All of you over age 64, COVID hit and you hung your cleats up. That's it. That's what that says. And then a big issue in the election, immigration, right? And what we see here is that native-born people, they are participating positively in the growth of the labor force. That's the red marks. This is the last 3 years here. Also, we have a very significant foreign-born participation in labor force growth. Total labor force growth is positive. And so the idea that you know, it's all or it's one or the other, you know, it's either all American, all native-born participation in labor force growth or foreign-born is not being borne out by this. It's both. It's both to give good and strong. We can see among the biggest readings of all prior years over the last couple decades, except for this reading right here in 2018. These are strong readings, all 3 of them. So the labor force participation looks good. And then one more economic slide. This is federal finances. We know we have a deficit problem. You can see this is sources of financing for government spending. Medicare, $1.7 trillion. Social Security, $1.4 trillion. Defense, $954 billion. So these are the big 3. Non-defense discretionary, $904 billion. Net interest, right? This is spending to fund the deficit. And then where's the money coming from? Income taxes, corporate taxes, right? There's this big discussion about corporate taxes. Look how small that is, right? Look how small corporate taxes are as a percentage of total taxes in the federal budget, mostly income taxes. Social insurance, right? This is deposits made from payroll into Social Security and Medicare, right? And then you can see increasingly Americans have been unwilling to pay taxes to fund their federal deficit, and so the government's had to turn to borrowing. But it's not doing it any longer at close to 0% interest rates, is it? Government's now having to borrow at 5% or so. So big question here, and we can see that the deficit as a percent of GDP has now surpassed what it was in the World War II period. Everybody can see that right there? So not all the news is super duper. Okay, we'll look at stocks now. This came to my phone the other day. This is an exact screenshot from my phone one morning, October 21st, 3 days ago. This came up on my morning texts. The S&P 500's decade of big gains is over. That's a big word. Goldman strategists say. Goldman's well known for being an excellent firm and you know, the smartest people in the world, right? Their analyst there is David Kostin, who's been doing this for a long time. You know, I put credence in what they say, and they came out with a call that the S&P 500's decade of big gains is over. Why would they think that? Going so good, you know, and I mean, people making money hand over fist. Why would they say it's over?
What goes up?
Yeah, that's part of it, David. Yeah. What goes up must come down. They're not saying it's going down, actually. What they actually say is you can expect 3% on average returns. Not down, but 3% is equal to inflation. So they're not saying down. They're just saying big gains are not likely. Why? Are the companies in the S&P 500 broken? Have the managements all turned into thieves and crooks? You know, is everybody just tired of working? Why? Well, we'll be talking about that. I have been talking about it in webinars, but I'll emphasize it again. We'll get to it. This is the S&P 500, and again, courtesy to JP Morgan for the very valuable work they do to put out something called the Guide to the Market. Every day now, actually, they have an update to their Guide to the Market. Intra-year declines. So this you can see we've had, look at all the strong years of the S&P 500. Actually, you could include these two. And only one big down year was 2022. And you can see that this is where the year ended. 24% up was last year. And at one point during the year, intra-year, the market was down 10%. So this slide is just designed to remind you that during just about any given year, there's going to be some period when the market's down at some point during the year. And if at that point you say, oh, market's down, sell me out of everything, well, you can't be a stockholder because there's going to be some point every single year when the market's got some, could be in the spring, could be in the summer. Everybody goes away. We don't know when, but there it is. And this year, year to date, this is just as of a few days ago, the market's up, S&P 500 is up 23% year to date, but there was a period when we were down 8% during the year. Nobody remembers that, do you? Anybody remember the S&P 500 being down 8% this year? Anybody? You don't even remember. Not a single person in the room remembers. And where are we on the S&P 500? Well, you can see it's been a long climb since 1996 with 1, 2, 3, 4 periods of big downdrafts. But here we are up on the peak of this mountain where we stand almost 22 times earnings on the forward estimates for the price to earnings ratio of the S&P 500. So that's a hint as to Goldman's pronouncement. Why would Goldman say the era of big gains are over? Because of that. 22 times earnings, right? If we want to see what is a return that's implied by that, right? We would invert it. 1 over 22. Who can do that math? Who's got a calculator? 1 divided by 22 gives 4 point something, I think, right? 4.5%. So that's the implied return going forward is a 4.5% return on the S&P 500. Not horrible. But if I can buy the US Treasury bond with no volatility at 4.2%, and we face this condition precisely in what year? 2000. In the year 2000, the S&P 500 was trading closer to 30 times earnings, which implied a return of 3% something, right? 3.3%. And at that time, the US Treasury bond, anybody remember where it was trading? What was it, Rodney? 0.5%? 5%? It was almost 6%, 5.5%. So in 2000, during the tech bubble, you could buy the risk-free US Treasury bond for 5.5% yield, or the S&P 500 for a 3 point something percent yield. Now, why were people buying the S&P 500 at that time, hand over fist, still at that time? Because they thought what was going to happen. What can offset the valuation? Kate, what is it? What's going to go up? Earnings, right? Earnings. The earnings were going to grow faster than the current valuation. The earnings were going to surprise, right? Somehow we were going to get this period where the market didn't see, but we're going to get much stronger growth. And at that time, that growth was going to come from the internet. Market doesn't understand that the internet's going to change the world and even faster even than that high valuation. It didn't turn out to be the case. People who invested in the NASDAQ market, which is a tech-heavy index, lost 80% of their money. 80. 4/5 of their investment. And it traumatized all sorts of tech investors. You lost $4 out of $5 if you plunged into the market at that time, especially the tech market. Okay, so we have an expensive looking market, and you can see that in this slide too, right? Here we are, 21.9 times earnings. We've had since 1994 only 1-2 other times when the market has reached that point on the way up. We've hit it 5 times, right? This one was on the way down when it hit it because it was higher. And this one was on the way down, right, to 2022. But here we are here, and you can see these are standard deviations. The average price to earnings ratio, 30-year average for the S&P 500 is 16.73. Please be clear, I'm not telling you where the market's going. I don't have any idea. I'm just talking. Valuations across the different types of stock, different valuations, different sizes of companies, small, medium, and large companies, value, blend, and growth companies. If we look right here, the current price to earnings as a percent of 20-year average, all are trading above their 20-year average price to earnings ratio, and one in particular. Which one? Large growth companies. We know all about them. They've been the big story, right? The big, large growth tech companies. But this is where they've hit. They're trading at 150% of their 20-year average. The more popular things get, the more people pile into it, right? And the more expensive things get. Doesn't mean, is there anything wrong with Apple? No. They're going to stop selling iPhones tomorrow? No. But the stock market in the process of investing is different. It's about price. It's about valuation. It always has been, and it always will be. So the point of this slide is sort of everywhere we look, it ain't much cheap. These areas, small companies, small value companies, trading at 107% of their average, that's, and that's why we give you a diversified portfolio that doesn't just include these big growth companies, right? And then if we get a client coming to us saying, why aren't you all large growth companies? Well, it's expensive. Don't want you to get burned, and I don't want to look bad. So you hold it, and believe me, if all that falls apart, you're going to feel it. Just hopefully not as much. All right, international equities. I've been talking about international equities for several years now, but you can see that the price to earnings discount versus U.S. equities continues to reach all-time, what would you call it, an all-time low. International equities are trading at 37% of the valuation of U.S. equities, right? There's been an average discount of minus 17% of international to U.S. equities. Anyway, the point of this is that international stocks, and we give you international stocks. Why? Because of this. Look, they're just super cheap compared to U.S. So I look at it and say, this gives us some defensiveness in the portfolio. In the event that the gaga rah-rah thing over U.S. growth stocks wears out, and eventually, as David said, what goes up may come down. So it's not that I don't think NVIDIA is a great company. It's just that this is cheap, and I want to give you some defensiveness in the portfolio if that day comes, because I think it will. Inevitably, they do. And you can see the dividends that you're getting paid. This is dividends versus international companies tend to pay higher dividends. You've had a big craze in the U.S. for companies to buy back their own stocks, right? What do they do that with? They do that with the corporate treasury that they would otherwise pay dividends. And so U.S. companies are not paying much in the way of dividends. They buy back stock. Not bad. It just means that there's less stock on the market of that company, right? But it also means the money's not in your pocket. It remains in the company's pocket. Not so international companies. They pay a substantially higher dividend to you. Anybody not like that? Anybody have a problem with you getting paid twice the dividends in your international stocks? Let me know. I don't have a problem with it. I'm happy to get the money. Okay, over to bonds. We're going to show you a few looks at the yield curve. This was 2004. Anybody think back to 2004 and where they were, what they were doing? I was starting a company. What were you doing? And this is what the yield curve looked like. It was a normal looking yield curve, we would call it. It's upward sloping. If you invested in bonds, which means to make a loan, or you were a lender, you were either borrowing or lending at a rate higher the longer that you did that loan for. Right? In this case, a 5-year loan to the U.S. government would have occurred at 3.25%. But if you only loaned money to the U.S. government for 2 months, you did it at 1.75%. That makes sense, right? If I loan to somebody for a longer period, they got to pay me a higher interest rate. Something could happen in between here and there. This is the normal state of the yield curve most of the time in history. And then 2014. So here is 2004. And what can we say about interest rates in 2014 versus 2004? They're much what? Why? Why? Not just much lower, like crazy lower. You got paid 0 if you lend money for 1 month, 2 months, 3 months, 4 months, almost 6 months, 1 year. You got paid no interest in 2014 to loan the U.S. government money for this amount of time. Why were people going for that deal? Anybody? Jim, why? Safety. Yeah, safety from what? This was 5 years on from the great financial crisis of 2008, 2009. And people were, and the economy was still not on its feet. And so interest rates dropped. They dropped because the Federal Reserve, which has control of only this rate right here, directly, they have some indirect control over these rates. But in general, the market was demanding less interest. And people were doing what with their mortgages during this time period? Anybody refinance a mortgage around 2014? Raise your hand if you did. Nobody? Refinance a few nods. Yeah. If you had a mortgage at 5% or 6%, you refinance it at 4% and so on. Now, here is the edition of 2020. October of 2020. What were we in the middle of in 2020? COVID. And look what happened. What do you see in this yield curve? Well, there was nowhere else for short-term rates to go in 2020. They were already in the basement and had been in the basement since 2014. But look what happened here. On the long end of the curve, the rates got even lower, right? The bottom of rates was June, I think. June, I believe. May, June of 2020. Summer of 2020 was the bottom, I think, of interest rates. Jim, is that right? I think that's right. And you can see that at that point, you could lend money to the U.S. government for 30 years at 1.5%. And you know what we at New Capital said? No, thank you. We didn't buy any bonds then. Like this. We were not going to lend money to the U.S. government for 30 years at 1.5% a year. This is where we are now. Is that crazy? Not only is it much higher, it also is what? What do you notice about this curve? It's what? It's inverted. You get paid more on a short-term bond than you do on a long-term bond, longer-term bond, right? Even on a 20 or 30-year bond. You get paid more on a 1-month treasury bond than you do on a 30-year treasury bond. This is what we call an inverted yield curve. It's not steeply inverted like that, right? It's kind of flattish. You're all right. but it is still an inverted yield curve. It's only upward sloping in two places, right here and right here. A little bit right here. Well, let's say right here to here, right? So it's a weird curve because it's got this belly in it. And this has dictated how JC and I have approached your bond investments. We have concentrated a lot here. We have moved farther out here over the past year a bit because we anticipate that these rates, when we say the Fed is going to cut rates, where is the Fed going to cut rates? Here or here or here? It's right here. This is the rate that the Fed charges. When we say the Fed's going to cut rates, they're not cutting all these rates. They don't have that direct power, only here. And so what the Fed hopes is when it brings rates down, and they did cut this was up above 5%, this short-term rate, right? And they cut it, what was it? Quarter or half? I don't even remember back in September. Half? Thank you, Rodney. They cut it a half, and this is where it is, and there's expectation that they're going to cut it and cut it and cut it. So that's why you have investors who say, well, I'm not going to wait for that to happen because that's going to happen. So I'm going to go ahead and buy bonds here because we expect this short-term rates to come down, and we'll get to a normal yield curve that looks like this because this end comes down rather than this end coming up. Right? We'll see. I have no idea. We give you a diversified fixed income portfolio. I have no control over the Fed. I have no control over interest rates, but we're not going to take a whole lot of risk in and put you in 30-year bonds that may still hurt on the interest side of things. Okay. This is the 10-year Treasury over 1 year. You can see it's been a roller coaster change over the past year in the 10-year Treasury rate. 5% back in November of last year was what you got on the 10-year. By January, it was 3.8%. That's a huge move, right? Then it moved up again through the summer or through May, back up to 4.6, then back down again. And now we've headed back up again. It's been a real roller coaster in yields. And so it's been tricky. It's been very, very tricky. And you can see that each year, just as in the stock market, we may get a negative period in any given year for the bond market, but by and large, the bond market puts up positive returns just about every year. 2022 was, of course, the big notable, big down year. Now I'm going to turn it over to JC. And then we'll wrap up and take some questions about it. Okay, we're going to talk model portfolios.
Alrighty, okay, so first slide here. For those of you that missed our last quarterly update in July, we have added 4 new model portfolios. So in addition to our existing global core, which is our legacy model portfolio, we have added a global market portfolio. This will not have the small in value factor tilts that we usually have in our model portfolios. We have a new US only ESG portfolio in addition to our existing global ESG. And we have 2 new US only portfolios. We have a US core that's going to have the small in value factor tilts, and then a new US only market portfolio with no factor tilts. So if any of these look interesting to anyone, we're happy to have a conversation about it. But we do have 4 new portfolios that we are offering. This is going to be our core model portfolio performance over the 1 year. So we've added some of our business partner portfolio performance in here as well. NCM in the first green bar. We've got BlackRock in the yellow, DFA in the blue, and Vanguard in the red. And you can see Model 0, this is our fixed income portfolios, all the way up to Model 10, which is our all equity portfolios. So they've all performed pretty close, but you'll notice that BlackRock has kind of exceeded here in each of these different models, and I'll talk to you a little bit in a couple of slides about why that is. But you can see bonds did about 7 to 10%, equities did about 30% across the board. All right, this is our model portfolio 1 year performance on our core versus market. So again, the core includes the small and value factor tilts. The market does not include those tilts. And you can see just about in every model, it's very close here as we trail out towards the higher equity portfolios. The market has exceeded a little bit in this 1 year period. And that's going to be due to no tilts in the portfolio. Okay, and this is why you'll see this is our equity allocations in each of the different partners in the portfolios. So BlackRock, DFA both have higher allocations to U.S. Holdings. Vanguard and New Capital, we have a little bit less in the U.S. and a little bit higher in the international allocations. And just over this last 1 year period, U.S. has just exceeded international performance a little bit. So that is why in the first slide I showed you of the performance, BlackRock had led the performance there because of their higher allocation to U.S. Stocks. This is our bond durations in our model portfolios. Leonard just talked about this in the treasury yields. So you can see here we are right here. So we're around 2.5 year duration in the model, the bond portfolios. We're still on the lower end because of the short end being higher yields where they're at right now. But BlackRock, Vanguard have stuck around the 6 year duration along with the ag right there. And so DFA and New Capital are stuck on the shorter end while the yields are high there. And that's it.
Okay.
Anything else you want to say on those?
Make it done on time.
Yeah.
We'll have some questions though. Okay, some themes. We're looking back 2021. We said we were going to shift to defense, and that was right because we got a big down year in 2022. We were worried about the valuations in 2021, and that was good. We were worried about inflation and rate risk in 2021, and as we can see, we got a double check mark on that, and inflation really materialized with a vengeance. We were worried about political risk back in 2021, and that materialized as well. And we were worried about valuation risk. So we did a pretty good job. We're just looking back to see what the themes were and bring you up to date. In 2022, we were gingerly shifting to offense in taking on more risk in 2022. After prices fell in 2022, we could take advantage of some better pricing. We were keeping duration short in the bond funds. Again, we've talked about that now for several minutes. We were worried about recession risk. We didn't know, but it was a concern. Recession did not materialize. And worried about political risk. And in 2023, a year ago, we were beginning to add duration back. That worked. That's a check mark. So we were moving some of the portfolio from shorter term bonds to longer term bonds, and that has worked out well. We said that valuations were attractive in bonds, international value, and real estate, and that we gave ourselves 2 checks because all those have done well. And we were double check marked, worried last year about political risk. We've given ourselves 2 checks on that one because it's only really continued to increase. And we gave ourselves 2 checks on our prediction of geopolitical risk. That also has continued to simply grow. So 2024 themes, we're considering strategic increases in fixed income credit risk. We may add some additional credit risk to your portfolios, meaning rather than trying to get you higher interest rates from taking on greater duration, greater interest rate risk, we may take on some greater credit risk, meaning lending to lower rated, not AAA borrowers, maybe in the corporate sector, could be in the emerging market sector. We're evaluating that, and we are talking to some people about that, and we'll see about that. But that would be a way to earn some higher returns as short-term rates come down, rather than us plunging more into treasury bonds that don't offer risk-adjusted returns at the farther end of the curve. Valuations are relatively, though not absolutely, attractive in international stocks and to a lesser extent bonds, because we've talked about the high valuation of the US stock market. So the key word here is what? Relatively attractive. Nothing's a screaming buy right now. You know, we're not in a period of fear and panic in the market that would have led to any sort of deal on securities, but there still continues to be relative attractiveness and valuation in these areas. U.S. political risk is at elevated levels, I would say, as we approach election day, and geopolitical risk is also at elevated levels with the ongoing conflict in the Ukraine and in the Middle East. So these are the themes for 2024, and we will be ready to respond to them. Okay, any questions? And then we'll take a break for lunch. It looks like we're running right on time. John Wilburn, please.
At the top of your presentation, you mentioned that we've moved out of mutual funds and into exchange traded funds. Remind me, how do you distinguish, what differentiates the two?
It's a good question. They are both funds. They're both mutual funds, technically, right? They take in money from lots of different investors and make a fund. So they're both funds. They differ in the way really that they trade. Mutual funds trade once a day at the end of the trading day, where they are posted for sale or for purchase according to their net asset value, NAV. Everybody gets the same price at the end of the day. So the advantage of that is that the assets price out, right? And you're buying those assets at what their mark-to-market price is.
You buy that the next day if that price holds?
Yes, the trade clears overnight. That's exactly right. And there's nothing wrong with it whatsoever. An ETF trades like a stock during the intraday period of trading, right? And so its valuation is based upon, it has a bid and an ask spread. So the purchase is not occurring at a single net asset value. It's occurring with a spread the same way that a stock trade does. There's a bid, right? Somebody who is a buyer and what they are bidding to buy the stock or the ETF at, and there is an ask price, the seller's price, and in between is the spread, right? And so the price you're getting is occurring just like it does when you buy Apple stock, right? You're not getting right at whatever the net asset value of Apple stock is, because frankly, we don't know what the net asset value of Apple stock is at any given time. It's a moving thing second by second. So the trade is happening with a spread, right? But it allows us to make and complete a trade during the course of the trading day, and we like that. There are also, I don't want to get too technical here, but there's some differences in the way that the taxation occurs also. ETFs generally have a thing or two that adds to their tax efficiency. But I don't want anybody to think you're getting anything less or both. If you held a mutual fund and an ETF, and Vanguard does and DFA does, and I don't know about BlackRock, but certainly Vanguard has different flavors of funds. And Jim, you'll correct me if I'm wrong, but generally you would expect the Vanguard S&P 500 ETF to perform almost exactly the same as the Vanguard S&P 500 mutual fund. He gives me thumbs up. Is that helpful? ETFs have come of age and they've become more popular because of their tradability, I would say. The fact that you can make the trade during the day, you don't have to wait for 4 o'clock to come around. Client wants to make a trade or we want to make a trade and we want that trade to be completed and we want it to post. It's nice for us to be able to do that during our working day. We get feedback right then that the trade cleared, right? But there is a spread that gets paid. On the other hand, Fidelity, where we're in custody, does not charge us as much on an ETF trade as they do on a mutual fund trade. So there's that benefit. By the way, we are exploring potentially opening a custody relationship with Schwab, the other big custody company in our business. If anybody's ever had an account at Schwab and like Schwab, we would be able to also offer you accounts at Schwab too. Just something we're thinking about. We've had one meeting with them. We had a good meeting with them. They would be interested in us. Yeah. Any other questions? Anything from the folks in the Zoom room? Nope. Catherine. The question is, how do you know what model portfolio you're in? And do you mean, how do we know what to put you in, or how do you know what you're in? Okay, so it's a great question. You can ask us and we'll just tell you. And that's one way. Another way is we give you quarterly reports, and your quarterly reports will tell you what you're in, because we have your portfolio is benchmarked to a number that matches your model portfolio. And so those quarterly reports are very useful in seeing how your portfolio is allocated.
And just to add, it also will be in the IPS statement that, or IPS document that everyone will be receiving next year, the investment statement policy.
Kate,
May have already done this because I haven't really looked at it, but do you have sort of a summary of pros and cons of the different model portfolios? You've already.
we do, and say it again? Oh, repeat the question, excuse me. What are the differences between our legacy core portfolios and the new market portfolios? And just very quickly, it really more than anything has to do with the fact that in the core portfolios, we have a larger allocation to value stocks and to small company stocks. And the reason for that, why would you want that, is because going back 100 years, those two types of stocks have had outperformance, sometimes substantial, but in general, if you put those two things together, you're talking about, on average, about 3% a year for smaller and value stocks, 2 to 3% a year. Well, that over a long period of time, that adds up, right? So over the long term, we would expect that the core portfolio would outperform the market portfolio. But it hasn't happened over the last 5 years. In fact, the other thing has happened. The market portfolio has outperformed the core portfolio. And so we're giving you a market portfolio. If you want to continue to take that bet, we're happy to do that. US similarly has outperformed international. Given where valuations are at, we expect international to outperform the US just based on valuation. Nothing wrong with US companies. But it hasn't happened over the last 5 years. If you want to continue to take that bet, we don't want to stand in your way. And if you want some of both, we can arrange for you to hold the core portfolio and the market portfolio. Or you might want to have some US only portfolio and some global portfolio. We made the decision. We're here to simply help you get what you want. We'll tell you if something worries us, but we wanted to make those portfolios available. There's no reason why we shouldn't make them available. And so we have. We did a whole webinar on it. We've got a whole bunch of slides on it. And so we can get anybody anything. It's a good idea to have some sort of short sheet on it. And yeah, if we don't have it, I think we do, but if we don't, we'll get that to you. A really good question. Anybody else? Nothing, your question, if you have one, will be between the group and lunch on the table back there.